Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Lance Pederson. Lance is the founder and managing partner of Verivest and the host of the Real Estate Risk Report podcast. And in just a minute, we're going to speak with Lance about Verivest, verification and monitoring. And but first, if you would like, we would love your help. There's a couple of things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you would like to see how handsome our guests are, you can check out our YouTube channel, and you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Lance. Welcome to CRE PN Radio.
Yeah, thanks for having me, Darren. Appreciate it.
Hey, you bet. Well, I'm looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Yeah, I think, for me, my background is I'm an entrepreneur at heart. So, went to college for a brief time, realized that wasn't for me, had a lot too much fun. And I think I, realized that more of the entrepreneurial pursuits are my thing. And so I started my first company. I was 20 years old. It was an IT services company. So built that from nothing to about 5 million in revenue and 35 employees, and sold that. And then I ended up getting into the real estate game via commercial hard money lending through a mutual acquaintance of ours, Darren, Matt Burke. He was in my EO Entrepreneurs Organization forum group. We became good buddies, and I joined forces with him in 2008. And then we pivoted the business in 2011 to really moving more from a private lending strategy exclusively to more of a capital allocation strategy, private equity, real estate investing. And that led to sort of the accidental business that we now refer to as Verivest. We learned quickly with our capital allocation strategy of investing in deal sponsors around the country that the back end, back office reporting was a big problem and was creating issues for us to report to our investors. And so we started offering it as a service. And given my sort of outsourcing type of background, and I headed that up, and it really took off. And now we're, 9 years later? It's a great business, and we've got about almost pushing 2.3 billion in assets under administration, and serving a big need. And along the way, we've sort of, uncovered, as entrepreneurs do, other issues or friction in this little corner of the world that is sort of sub-institutional real estate investing, and have tried to eliminate or remove as much of it as we can to help all the participants, limited partners or investors, and general partners and deal sponsors.
I love the path, even from college, recognizing that wasn't the thing, to, following your entrepreneurial spirit. And then it sounds like you have kind of an awareness of a problem, and when there's a problem, kind of find a solution if there's not one, I'm assuming. And it sounds like it's worked out pretty well for you. So let's talk a little bit about Verivest. Mm-hmm. Can you describe just what is Verivest?
Yeah, I think at the core of what Verivest is we're really a middle and back office administration platform, for the, like, what I call the sub-institutional real estate space. And, and it's really with the proliferation of syndication since the passage of the Jobs Act, right? You've got a lot more high net worth investors and, smaller family offices that are investing into, funds or one-offs or syndicated deals, 50, 100, 150, 200 grand at a time. And so, there's a lot of moving parts that come along with that. And so at Verivest, really what we're trying to do, I think now, as the years go by, the clarity becomes greater, is that it's really trying to help match interested investors, match and, educate and match limited partners or passive investors with, general partners or, deal sponsors in the space. Because, I think the commonality between the deal sponsors is that these aren't household names. We're not talking Blackstone or KKR. So you have no brand recognition. If you're really good, it means you probably have a really solid acquisition strategy, whether you're originating loans or you're buying houses or multifamily buildings. If the better you become at it, then your pipeline becomes, it burgeons and really capital becomes a constraint. And then managing that capital, right, those investor relationships and all those things is very different than acquiring property and even the asset management, right, which is what many of the participants in this space, that's their passion. They're deal guys. They like negotiating. They like underwriting. They like, real estate for, for the real estate. But yet, what comes along with it is that you really need to use other people's capital to grow and scale a real estate investment firm. And I think from the investor side, right, it's now that they're aware that you can allocate capital into these alternative investments and specifically real estate ventures, and to the degree that you're accredited, especially that's what most of the opportunities are available to them. It's just you can really generate outsized returns, right? And I think above average risk adjusted returns. And but the issue, of course, once again, is figuring out who's offering those investments and then figuring out whether or not you should trust them with your money. I think is that problem now that needs to be solved. Back in the day, if you were going to invest in a deal like this, it was probably in the town you lived in, right? And you probably heard about it from buddies on the golf course, and that's fine and dandy, but that's not super scalable. So even for many deal sponsors, even as human beings, how many relationships can we really build? It's some of us more, guys like me, fewer. I'm introverted. I think many real estate guys are probably similar. So it's hard to go out there and sort of build the net new relationships with people that are in your locale. Are sort of a finite number. But now that we can advertise these things broadly, you can develop relationships with the power of the internet, but you run into this problem of, there's limited oversight and regulation by design, which is a good thing. We want to keep it that way. But at the same time, we want to make sure that the good guys are winning and that who they are. That's sort of when I woke up this morning, that's really what I'm all about, Darren, is I woke up this morning a leader of a movement. I really believe that this is what the industry needs, is this fair play, to ensure that it can proliferate. And I believe that limited partners deserve to have greater transparency into these investments. I'm going to lead the movement and try to help create and foster the solutions and implement them so that continues.
Got it. So Verivest, you guys kind of sit between the deal sponsors and the investors as far as a kind of a lens to look through that looks at the deal sponsors and kind of, now do you rate them, or do you just kind of composite or profile the information, or how does an investor, what do they see when they look at a Verivest? Is it a report, or is it a subscription, or how is it that the information is made available?
So the way we've structured that component of it is we've created a directory. So each sponsor has a profile. And so investors can go there and they can filter that directory by, property types, geography, sort of narrow down like who's doing deals that look like what I'm looking for. And then we don't rate them, but what we do is we say, okay, well, if you want to be a verified, you want to be Verivest verified sponsor, then you and the principals of the firm, those who control this firm that you've representing, your company, need to pass a background check. So we'll look back 7 years, and you can't have any felony criminal convictions, no personal or business bankruptcies, no unresolved accusations of fraud from investors, no regulatory sanctions, the bad boy stuff. And then the results of that background check are publicly accessible to the world. So even if you've been in some lawsuits, those are going to show up. It may not be a disqualifying event from being Verivest verified, but nonetheless, those are the things that show up, because is we know that's sort of where you can find some red flags. People are highly litigious, although it's not my place to sort of pass judgment on what's too litigious or not. And I'd rather not do that. And Verivest would rather not do that. If we make that information transparent to the investors before they invest, they can say, well, this person, although, has no one's accusing them currently of fraud that hasn't been resolved, they seem to keep running into issues, right? So giving that information, and what happens when they know that's going to be accessible, the guys who have questionable backgrounds, guess what? They don't participate. And then for those who do participate, it's sort of that reminder every day that they wake up to sort of keep their nose clean. So to me, that's that component of it. And then the other big piece that we do, once again, we're not rating it. We're just to us, it's all what's objective and empirical, and what can we measure. So if someone's telling me on the phone that they've acquired $500 million worth of multifamily properties, it's pretty easy to say that. I, as the investor, having just met them minutes before, how in the world can I corroborate whether or not that's an accurate and true statement or not? I can't. So what's happened in this business, which is one of the reasons why I sort of, and why Verivest started to go down this road, is that I saw that misrepresentation was becoming rampant. And that's a problem. And I think that unfortunately, many of the participants in this space, deal sponsors or real estate guys, I don't think they fully appreciate sort of how important it is to not misrepresent yourself, right? So it's fine to exaggerate your fishing expeditions and your high school football career. I mean, it's not fine, but I don't care, right? Like it doesn't affect me. Right. But you exaggerating the length and your track record is a problem. Those are securities violations, and it's serious stuff. And you being in the insurance business know this. You got to take licensing and tests. And I've been a registered representative and an investment advisor rep. I've had to pass the tests. I know how important those things are. But it's happening, and it's happening too much, and we have to clean it up, right? Like it can't be that way. You can't fudge numbers like that, because people make decisions based upon that information. And it's been great because we've been on a historic bull run, so everyone looks like a genius. But at some point that stops, right? It's these market real estate is cyclical, and it will cycle. And I just don't want to see a situation where a bunch of people raised a bunch of money, did a bunch of deals based on, fabricating sort of their claims. So we allow sponsors to pay us to verify their track record, right? So my whole thing is, listen, pay us once. We're an independent third party, and just keep paying us to verify the things you do. You now have a living track record. So when you make the claim that you've acquired $500 million worth of real estate, you can literally say, well, don't trust me. Just go look on my profile on Verivest, and you can see that, that they've already checked it, right? And so, and I think that removes a lot of friction from that, what amounts to a sales process, fundraising and getting someone to invest in a deal. That's friction, because I, as the LP or the passive investor, if I can't corroborate that, it's going to cause me to do things differently, right? I may write a smaller check, right? I only invest 50 grand instead of, even though I could write a $200,000 check. Or I may decide to pass on this deal and wait 4 deals later to get more comfortable and see more before I invest. Or I may not invest at all because I just can't bring myself to doing it without being able to corroborate those claims. And then for us, the last piece we do is just after someone makes the investment into a deal, most of these things don't have audit requirements, right? So no one's really, a tax return is being done by a tax preparer, but he or she's not digging into the details, right? So what we do is we have a service where we'll monitor that deal on a quarterly basis and basically review the financials. It's like audit light, where we're making sure that the fees that are being charged, are being calculated correctly per the operating agreement, making sure that all the money's going where it's supposed to go, make sure that the assets that are on the balance sheet actually exist, and make sure that there aren't any, related party transactions or money going out the back door, which is most Ponzi scheme and fraudsters. That's what they do. They have control of the money, and the money has its way of sort of disappearing and sitting in some intercompany account, or,
right. Not making it back to the investors.
Yeah.
Right. Hey, so you mentioned kind of the, the fishing tails, or just the kind of the not the truth per se. I'm curious, in your discovery mode, have you found that those are typically like intentional, or are a lot of them just like they don't know the rules and the boundaries as far as what they can and cannot say?
I think what happens, Darren, is that because they aren't necessarily paying super close attention, it's so what happens in conversation and then ends up translating into email communication oftentimes is that we always throw out sort of these round numbers, and the numbers, just I think depending upon the person, tend to be anywhere from 10 to 40% more than they really are. So what we've seen already early on in this process is just in my in our conversations with the prospect, this prospective member up front, like, hey, well, about how much do you think it is, or whatever, right? And then when push comes to shove and they actually give us the information, then we start to see that there's a gap, right? And then you start to hear yeah, but I included the stuff that I did when I worked for this other guy that did whatever, and and it's just it's once again, it's not like they're trying to lie. That's what I mean. It's just that they don't think they realize that, okay, but you have to be able to prove it, right? Like, and so there's you've been in the business and you're seeing a lot of LP activity. A lot of investors are kind of getting into syndication games. So what you're also seeing is people that have invested as LPs in deals sort of trying to count that in, these claims about how many doors they have, or and it's just stuff like that. It's like, I don't have a problem with it, right? Like, obviously, you making a $50,000 investment in another person's deal, to me, is part of your track record, right? Because you made the investment. So versus you not having made the investment, it makes you more experienced than the person who hadn't, and then of course, if you make the investment, the deal goes full cycle and it's a win, then you should get credit for identifying an operator and a deal that you invested in. And would you get as much credit in the mind of a prospective investor as you would for someone who actually found the deal and bought it, managed it, and operated it? No, but it's so that's sort of the way I look at it.
Yeah, no, I think that is kind of one of these, when you get down to it and you really study the numbers and stuff, I found that to be a consistent thing where somebody will say, yeah, I'm in, hundreds of doors or whatever, and you find out that they're fractional, and like I said, they are invested. So I don't want to like take that away from them, but it's more a matter of, I guess, clarity on and kind of understanding the level of participation, kind of thing. And I think to the good, again, being involved in a deal and stuff, and watching how others operate and stuff definitely helps one see how to or how not to, or what, how to overcome certain situations or whatever. So there is value in that, but definitely it is kind of an interesting tale of sorts that you've got to try and parse to try and fully understand where somebody's sitting.
Yeah.
Uh, um, so you guys then, if somebody is Verivest verified, then you will do like a quarterly. Is that basically taking their quarterly report and then just measuring that against, what you find, or how deep does that go? You said it's kind of a light, but I'm just kind of curious.
Well, yeah, I mean, I think it's light and compared to a full-blown financial audit. I mean,
Sure.
so I'll tell you what it is, and you can tell me if you think it's light. So,
Okay.
yeah, and for the record, too, the other state of member we have are the Verivest verified gold members, and a gold member is someone who's engaged us to monitor the totality of the amount of capital they have under management. So what they're doing is, on a quarterly basis, they are sending us their income statements, balance sheets, bank statements, bank reconciliations, and a general ledger detail, and any backup documentation on acquisitions of assets, or dispositions of assets. So basically, they're sending us the financial package. One, what that does is it requires you to actually have a process in place where you're closing your books at least on a quarterly basis, which actually disqualifies lots of people. So another pet peeve of mine. I don't understand why that's such a problem, but and how you can actually operate a business without doing that. But nonetheless, we requested information, which is information that should already exist, right? If you've done a closed process, everything I just said is readily available. We take it in and we make sure that everything ties out. Income statement ties to balance sheet, the bank statements tie to the bank rec ties to the balance sheet. Because see, that's how people sort of fabricate things, right? Is that it's really hard to like fabricate financials. But if I get that total thing, I can basically tie everything out with all the reports I just said, if you know what you're doing. And we do. We have a bunch of accountants that work for us. So that's sort of what we do. And then we spend much of our time focused on money out, right? So the cash out the door is where we hone in on, like, okay, I mean, money came in, that's great, but where did the money go out? And we look at the operating agreement, and says the manager is going to earn an asset management fee, and the property manager, who's a third party property manager, is earning a fee based on this. We're going to go make sure that the fees that those people are earning is actually the amount that they should be earning. Because that's the other thing that happens, is that, well, no one's paying attention. I'll pay myself double, the asset management fee. Who's going to really notice, right? And the reality is probably nobody, but we do. And it's sort of, that's that proof that it's like, hey, everything you're seeing here is legitimate, and you can sleep well at night knowing that someone who knows what they're looking at is looking at it regularly on behalf of all the investors.
No, I would think that's definitely a higher level of certainty, and would give any investor, comfort to know that everything is, because like you said, and I think, real estate lends itself to a lot of lesser sophisticated operators from a standpoint of just, getting the once you qualify for the loan, kind of things you talked about as far as management and operations. The reporting requirements aren't that great. If you're operating your own deal, you might have to provide a financial to the bank annually or something like that. But when you have other people's money, and have to be able to provide them the level of detail or some sort of report that assures them that their money is where it's supposed to be, and that they're going to get paid and they're going to get their money back. That's definitely a degree of reporting that they may not have been used to on their own deal, kind of thing. Whereas when they start working with others, it's absolutely a requirement.
Yeah, I mean, and it should be, right. And that's why I always tell guys all the time, like, well, it just seems like this is a lot of stuff. And I'm like, but you understand, like, if we don't, as an industry, start doing these things ourselves, then what's going to happen is, and we're already seeing some of this, is that it's the regulators are going to come in and start requiring it of more people. And all that's going to do is the way that they'll implement their regulatory regime will be far worse, and will make it so that most people that are trying to participate now, the barrier to entry will be even higher, which is what, I think we're starting to see Wall Street sort of realize that the public markets are shrinking, their ability to generate, alpha in that market's not there. And, they've got lobbyists looking for ways to sort of, get access to more of that retail type money, the accredited investor money. And it'd be a hell of a lot easier to do that if it wasn't all flowing to a bunch of, random, highly fragmented individuals in all sorts of corners. Anyway, the point is, it's the right thing to do no matter what. I think that it definitely demonstrates that you have competence, right? That you're able to do that. You're willing to be transparent, which is the whole point, right? Is like, how do we narrow down the universe for this prospective LP who may not be as sophisticated yet or whatever? We need to narrow it down. It certainly narrows it down, and then it gives you greater certainty. And it's a way for those who are really good at what they do to demonstrate that to the world, when they may not be the world's greatest marketers or have the best branding or whatever. But that's sort of what I'm after. We know, we're very active investors ourselves, the guys who are some of our best operators that we invest with, I mean, on the surface, they don't necessarily look like they are, right? But they're the type of people that do everything that we've been talking about during this episode.
Right. So do you, does Verivest offer a verification for individuals that are doing one deal at a time, or is it more fund oriented?
So, yeah, I mean, the one deal at a time, if it's syndicated equity, then that fits in, right? I mean, those who are like acquiring single family homes with their own money and some bank.
No. Yeah, I wasn't implying that, but I meant more like somebody that's doing a syndication, as opposed to a fund.
Yeah, definitely. I mean, I think the syndications are, it's really targeted at syndications, and those who've graduated to using funds is really I mean, I think the key here, right, is that it's any time that an investor is putting money in where they're in that limited, they're a limited partner. They have no rights. They're completely abdicating the decision making authority to some other party. That's really the rub.
Right. Are you seeing more of the experienced syndicators leveling up to creating funds?
Yeah. I mean, I think we are. It's a bit of a love hate thing for people, but I mean, I think what I've been telling guys, is that if you're in a position where, you're going to syndicate 6 or more deals in a given year or something, you really should think about sort of launching at least what may amount to like a co-GP fund or just a co-investment fund. So, the fund may not end up, wholly owning all of the assets. I mean, that's a pretty steep climb to sort of go straight from syndicating one deal at a time to that. But it's a good interim step, right? To demonstrate to your investor base, like, hey, there's more efficient ways to sort of capitalize our deals, and we're getting to the point where we need to start using those ways, which would be a fund. And I think it's a good, so rather, because a lot of people look at it as very binary, like I'm going to syndicate each deal, or I have to have a fund that's going to raise all the equity and control all the equity in the deal. And I'm going, yeah, that's a really steep and wide, deep and wide canyon. That's a really hard leap to sort of make. But I think that offering that and starting to put that in place early, where it's like, hey, and we did that, at Fairway America, that was sort of what we did, is say, hey, we're going to start syndicating some deals one off, but the first look's going to go to those who are fund investors. So for the investors listening, I think you got to understand that the more successful people they become, and the more velocity they have, it sort of may make sense for them to make that leap. And don't be surprised that that's sort of what happens, is they'll say, hey, I'll give you a look at these one-off deals that you've grown accustomed to, but only if you make an allocation of the fund as well.
Well, that makes sense. From a standpoint of, you have the investor's capital, you've implied you're going to put it to work, and they've gone with you, and now you have an opportunity to reward or invest their money and make the the returns that your investors are looking for. I find it fascinating just how, and again, kind of going back to the impetus of all this, kind of the Jobs Act really kind of freed up all this, or created all this opportunity, whereas before it was kind of like, like you said, if you know somebody at the golf course, and just how it's kind of proliferated, and really, kind of what you identified as well, is just you can do this, but how good are you at marketing or attracting capital? And as that space kind of becomes more known and crowded, how can you stand out and make certain that people know that you can do, are able to, and provide the returns that they're looking for, and have something like Verivest that can actually provide some transparency to it, and third party. I think it's an awesome idea that you guys created this, and I'm the few syndicators I've talked to that are clients of yours, are going, wow, this is exactly what the space needed, because of just the lack of the ability to discern, an operator that is doing well versus one that tells a good story, one that's more marketing oriented, kind of thing. So I think that's a great thing. So you mentioned, at Fairway, you guys were doing the funds and also sponsoring some deals. Do you find that all of that experience then also helps you be that much more able to discern? Because obviously everything we've talked about so far has been more about numbers. Do the numbers match? But I'm just curious, your own experience, and having been in the market as long as you guys have, are there things that you for that maybe that the numbers don't tell that help you? And again, I know you're not grading, you're not providing any subjective reporting, But I'm just kind of curious, does it show up anywhere, that experience you guys have?
Oh, most definitely. Yeah, I mean, most definitely. I think that um, my take is on everything we've spent all our time just talking about is the sort of thing that removes a bunch of the bias we have just because we're human beings and we're attracted to certain people, and like, you know what I mean, like you've got that whole thing. We just, there's so much bias built in. So as investors, and it doesn't matter if you're a real estate investor investing in equities, like it doesn't matter. I mean, to be a good investor, you need to learn how to um, keep yourself out of that as much as you can. You know, you can't be emotional, right? It just can't, right? Like you have to have a process. And so for us, what we found is that, you know, we were no different. We're professional investors. But you know, we were as susceptible as anyone else to just those marketing things and the charisma of a given operator. And of course, for human beings, we're going to be. So the things I think that are important, that's why I say, take this stuff off the table, right? Like this is stuff that's empirical and objective. Take it off the table. Okay. So you know what you're dealing with. When it comes to the people, I think one of the most important things that you have to look at as a passive investor, and the things we've learned through going through this process of like, you know, how do you do it and become better at figuring out who you should invest with and what deals you should invest in, is that it really is about the people. So it's looking at who's on their team, right? Who are these people? What roles do they play specifically? And what is their background, right? Which once again might not necessarily show up on the track record stuff that they have as a principal and as principles or whatever. So I mean, it's still, these other things are important. And then the other big thing is just what's their strategy, right? Like, do they have conviction about their strategy and their mandate? And is there a method to their madness, right? Because it's they, and once again, there's no right answer per se, but if they don't have clarity about how they do what they do, why they do it, you know, all those things, you need to dig into that stuff, and you need to be able to get to buy into whatever it is they're telling you, right? Because that's the risk mitigation part. Like that's the extra. It's like, how do you do what you do and why do you do it? And then you have to ask yourself as an investor, does them doing that mitigate risk, right? Like if you, like a multifamily guy who goes in and makes a big deal about having social services for their tenants and you know, and whatever it is they're doing, these different types of amenities, like those are the people who thought through that. And they've got a bunch of different things they do. That's like their playbook that they run. You need to be looking for stuff that has a little more depth to it than just like, we buy ugly apartment buildings, or, you know, I don't know, right? Like you want to push on all those things to see if there's any depth to it or any conviction behind it, or they just looking for the passing fad, right? And that's why, I mean, I don't like to be the guy who says like, oh, people who invest in markets they're not in, that's impossible, and I would always pass on them. Maybe that's your own mandate or philosophy. That's fine, but it's not necessarily true that someone couldn't live in California and invest in a bunch of multifamily deals in Arkansas. But I want to know how in the world they're going to do that, you know, and do it successfully and ensure that, you know, that they're not, you know, that there's not risk that they can't mitigate because of the distance, as one example, right? Like, so those are the things we've learned. Like, it's just not easy. It's not simple. And you really have to like do your homework on everything.
Yeah, no, I think the question that I think is outstanding, and I think it's just across the board, and it kind of goes back to the start of this when the Jobs Act passed, and how the market has been running up ever since. And you know, how many guys got in when the market was upside down from the you know, the Great Recession, and have been able to produce these amazing returns. How does their experience translate when there is the you know, future dip, correction, whatever you want to call it? I think ever since I've been doing this podcast, there's been a you know, an anticipation that we're in the late innings of a baseball game, if you will, for an analogy, and that you know, it's coming, but there's continually these different you know, factors that have changed the lay of the land, or that continue to promote this run. And so I think it's crystal ball business is not what I'm. Oh, I mean, I don't think anybody has one, but it's, I think just again, everything that you've talked about, just it'll be interesting to see how these players do when the market is corrects itself or whatever the next challenge is. And it's not even necessarily a correction, but just a change in the course of the winds, or the winds blow a different way. So
you got it. I mean, a book that I think many people quote as one of the greatest business books ever, right, was Good to Great by Jim Collins. The whole book is based on studying comparable firms that we've all heard of, head to head, right? And which ones are the ones that went from good to great. And so at the heart of that, and if you follow Warren Buffett at all, right? Like, what's his whole thing? It's all about the teams. It's all about the leadership of these companies or whatever. So it's this intangible stuff. It's like, what are they made of? What's in them? Because what happens is, that's why you have to figure that out. And that's why we don't, at Verivest, I don't tell you what deal to invest in. I don't want to do that. I don't want to be in the business of saying, shilling this deal, like, put money in this deal. It's the greatest deal in the world.
Right.
I'm like, I just don't believe in that. What I believe in is, like, that's your job. You're an investor. If you want to be in the game, then you need to learn enough, educate yourself enough to do. I'm going to help you. We're going to do as much of that stuff that's really hard to do for any given individual, but you can do the stuff I'm talking about. In fact, that's what we tell our sponsor members, is that we're providing you, because we have the level of insight into your operation as we do, our willingness then to provide you with a platform to share what you're made of with the world goes way up. Because if I didn't have that level of insight, I'd be super nervous that I'm letting some, charlatan up on stage, tell you how great he is. Right. So to me, that's not my job. It's not my job to pitch the deals. It's not my job to sell why I'm, this guy's great at what he does. It's their job. And if they don't figure it out, they won't get capital. And if they do figure it out, they might. Right. And then investors need to also do the same. They need to dig in and see what makes these guys tick and what are they all about. And do you believe in it or not? I don't know. I don't know the answer.
Right. No, and I think, there's always a degree of risk in that, but I think just to try and eliminate the noise as much as possible to where you can, see the numbers and make it more empirical. It certainly is a good starting place. I'm curious, is there any asset class that you guys don't work with as far as any of the investors? Or do you work across all the asset classes for real estate investors?
Yeah, I mean, we work across all the asset classes for real estate. I mean, we've got guys doing tax liens and single family, multifamily. I mean, I can't think of anything that, obviously some of the special purpose stuff, we probably haven't done anything with the ski resort but it's not to say, I mean, we wouldn't stay away from it. So, I think for us, that's the other thing. It's just, hey, if it's real estate and there's a strategy you can put around it to acquire it and add value to it and do whatever, then it makes sense. And some of this ATM stuff, which isn't really real estate, it's like personal property, seems to be popping up. I've got a client who's, thinking about doing a fund with one of those. So that's kind of different, but the mechanics are kind of the same. Now on the monitoring front, that's not something we could monitor as a good example, because I have no idea how to keep track of 3,000 ATMs around the country, right? Like,
right.
But I certainly know how to figure out, with real estate, it should be titled. And, with the technology that exists today, we have much higher levels of certainty that things are properly titled.
Right. Well, income and expenses, right? So
income and expenses is banks and cash and tax returns. And, so there's, when the financial side, it really is, I know it's complicated to lots of people, but when you do know it, it's like, it's either right or it's wrong.
Right. Math.
Yeah.
I like it. Got it. Lance, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker and work with my clients to assess risk and determine what to do with the risk. And there's three strategies that we typically consider. We first look to see if we can avoid the risk. If that's not an option, then we look to see if we can minimize the risk. And when we can't avoid nor minimize, then we look to see if we can transfer the risk. And that's what an insurance policy is. And I like to ask my guest if they can look at their own situation. Could be their clients, investors, the market, tenants, interest rates, however you want to define that. But if you can take a look at the situation and identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. So if you're willing, I'd like to ask you, Lance Pederson, what is the biggest risk?
Yeah, I mean, this is a biased answer, but I wouldn't be doing what I do if I didn't believe it. I believe that the lack of oversight, and I mean, is as it pertains to a limited partner investing into a deal that's controlled by somebody else, is just, if no one's watching what's going on, that's the biggest risk that you're more than likely not being compensated for. In whatever return you've been quoted. So to me, to your 3-step thing, I don't know how to transfer it because there's no one's writing. I mean, I've seen a few where you could insurance on stuff like this, but that's ridiculous. But you can minimize it, right? And I think that's what Verivest does. Is we just minimize it. Is it foolproof? No, it's not. But it's a big deterrent, right? And you take that off the table. So once again, much like insurance, the cost of the monitoring, and even in the light touch in the way we do it to keep that cost down, it certainly minimizes what I believe is your biggest risk. Is just something goes sideways, the guys stick their head in their sand and they start moving money out of the deal, and you don't become whole because of it. How many times have you heard that?
Yeah,
too many.
No, absolutely. The ponds here, just again, like you said, people aren't watching the numbers and nobody's paying attention. And there you go. Lance, I can't say thanks enough for taking the time to talk today. Before we wrap up, where can listeners go if they'd like to learn more, connect with you?
Sure. I mean, so you can go to verivest.com, check out the directory. There's a little chat bubble there. I currently man that. I like to be on the front lines as the service gets off the ground, so you can chat with me there. I'm on Twitter at L Pederson, Pederson. Pretty active on LinkedIn as well. So yeah, it's pretty easy to get a hold of me or find me.
All right. Lance, again, I can't say thanks enough for taking the time. I've enjoyed it, learned a lot, and hope we can do it again soon.
Yeah, thanks, Darren. I appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.